Good day, everyone. This is John York, and I am doing a video lecture to cover the deal with a focus on equity, which will be followed by a second lecture, which will focus in on more of the debt side of the equation. So we're going to focus here on the deal, and the deal is driven by a few things. First of all, it's an agreement, it's a contract between at least two parties. It can be multiple parties as well. And the key pieces that you have to think about in the deal are going to be cash flow streams. That's the amount and timing, just not in terms of the present dollars that come in, but really we look at future value, the risk. This is very important, especially with a startup, in terms of risk and de-risking, and ultimately values in terms of present value, which may be pre-money, and then future value, which would be not only post-money, but money that, as you're hitting certain milestones, achieving certain sales targets, that the value of the company increases. And the partners that are involved here are naturally going to be the startup, but you can have a diversity of investors that are there. In doing equity, you may have private, you may have angel, you have VCs, which most folks think of. You may even have corporate VCs involved and individual investors. With respect to debt, you're going to be dealing with banks, commercial banks, financing companies, leasing companies, and other creditors. So what will you need? So the reason why this is an important discussion is previously we talked about, we need to have a part of our business plan. We need to have a very good finance section. And in the finance section, we do have what we call looking backwards in terms of our common financial statements, most commonly the balance sheet, income statement, and cash flow. And cash flow is important for cash burn. But looking forward is, you can see on the right-hand side, is really a pro forma, which takes into account in terms of basically the drivers to revenue. That would be in terms of, in this case, with this surgical product, the number of procedures, units sold, price per unit to drive revenue, and ultimately have a forecast relative to revenue, subtracting your cost of goods sold, any royalties to get you a gross profit, and ultimately then what I call your SG&A, or sales, general and administrative, even your R&D come into this place. So that you can get to EBITDA, or earnings before interest and taxes, or a free cash flow. And this is critical, especially as you try to, as investors, look at future value to discount back to present value. So as an entrepreneur, what you have to think about are a number of items. Naturally is the money, but also is you need to think about debt or equity, how you're going to finance that. And there's some trade-offs we'll talk about a little bit later. We have involvement of your investor in terms of not only share of the company, which you dilute out in terms of your equity, but also management in terms of recommendations for individuals to be a part of the management team, and board seats. And that partnership is very, very critical. So I think you've heard from past lectures how it's important to have good partnerships, whether it's a franchisee's franchisor, or with your investors, and even with your startup team. And then you have to also think about your real need for cash. One of my colleagues, Charles Zoll, has said that you should constantly be looking for money so you're not in the position of being desperate for cash because of the time lag. And then also think about your inflection points, because that's very critical, because your inflection points are going to drive in terms of your revenues. That would be if you are going to be moving forth to a model that will be looking at deriving revenues from customers, or if the inflection point is that you're looking to license out your technology, or you're thinking about selling. Because what's important to investors are not just the time and the parameters around getting in, but also the timing and the exit that is there, so that they know that they have specified endpoints for a closure of their investment. And with some funds, it may be 10 years that they have the fund. Some maybe 5 years. Some individuals might be 3 years. So we have some choices in terms of debt financing versus equity financing. And we're going to be focusing on equity, and there's some advantages and disadvantages. I think that the big thing about equity versus debt is that equity is that you have less risk, and you don't have to pay back the money, so they have ownership in the company, and that they have your investors have networks for future investment, and they're not necessarily looking for immediate return, so they can't just call in the loan like the bank is, and that you may have fixed payments, which will allow for better budgeting. The disadvantage is that investor returns could be much greater than the debt payments, and that you have ownership issues, and that they would be involved both at the board level and even at the senior management level relative to decisions. It's not unusual to see not only VCs coming in and dictating location and also CEO, but also board seats. And I love the fact that we see a lot of startups in San Francisco because investors are up there. So it's something that has to be taken into consideration. So let's talk a little more about equity. So this is just the food chain for entrepreneurs, and I had previously discussed this with you all. But as you see from the stage of the venture, from R&D to high growth, okay? So R&D being very, very early rounds, and what we're seeing is the values are much, much lower on the R&D side, less than $1 million, to where high growth you're looking at, value of the company being hundreds of millions and into the billions of dollars. The sources of equity from the R&D and into the seed stage, as you can see, will be a mix of friends and family, grants like SBIRs, and then high net worth individuals for R&D, and then seeing angel and seed funds coming in for seed. As you get into what we call the launch stage, this is where you get VCs involved with Series A, B, and C, and more angels who are very high net worth individual, and some private equity. Lastly, as you go into high growth like Uber or Lyft, you can see that taking the overall capital markets, you're looking at some significant growth. The amount of capital invested, as you see on the lower end, tends to be anywhere from 50 to 200 for R&D to and that especially with some of the grants like SBIR, STIRs tend to be in the 150 range. Seed end up being 10 to 500. In fact, Tech Coast Angels will go out to 750 for seed round, and then as they get into launch, they may do $1 million, or they may go multiple millions as they are lead angel group of multiple angel groups going in. And then ultimately for high growth, you're looking at tens of millions to hundreds of millions of dollars. The company, as you can see, what happens is over time is there is a dilution factor that does come into play, and most likely what you are hoping is that the share price and the numbers that you have, that the share price is going to increase significantly with each stage, and that you are probably in your ownership of those shares probably going to see anywhere from 1 to 5 million initially, out to 3 to 5 million in the high growth. So it's important to recognize that investors, especially at early stage, have expectations in terms of return. And so as we can see in the early stages, that you can see very high expectations for returns, but they're also looking at holding periods anywhere from 5 to 10 years, especially in the first stage, but even in your seed stage, we're looking at 10 years, especially in R&D type of businesses. As you progress into further rounds, so second stage expansion and bridge, you see that the rate of return is reduced. It is not as high as the 50 to 100% or the 40 to 60%, but now you're into 20 to 30%. And then you have the last two areas, which we call levered buyouts and turnarounds, where because of the risk involved, because of a company being financially underperforming or close to bankrupt, the return expectations again are much higher. So another concept that we need to keep into consideration is what we call pre-money versus post-money. And you'll hear these concepts talked about. And pre-money value is the money value that has been valued by the investor looking at your company at time zero. So it's before the investment. And then you having your investment and then leading into post-money value. So after investment is that value of the company with the investor's money plus your pre-money value that the investor has been able to define. And you need to keep in mind that in this, as we see in this example, you may have multiple drops of money. As you see here, 0, 2, and 4 have investments of money that allow for one, an increase in the post-money value, but also two, and we'll talk about this a little further, the decrease, or I would say the dilution of the ownership by the entrepreneur. And this is the concept of dilution is basically you may start pre-money, 8 million shares, but once you have brought in additional money, you have now diluted out your percent ownership post-money of the business that is there. And a good example of how this is calculated, this comes from the Solomon note that we had in our readings, is that there's a calculation in terms of current value. And if you focus in on rounds 1, 2, and you have a calculation of the final value. But what I want to point out very clearly is that as you move from round 1, where we have calculated in terms of ownership value with the first round of individuals, and then you add in the round 2 and round 3, and you see dilution that occurs as we move from round 1 to round 2, and round 2 to round 3. And what happens is that 34 to 30% is driven by not only the round 2, but also the round 3 investment that's there. And as you can see, the round 2 investment is driven down by the dilution factor of round 3, which is the final round, which is not diluted. So anyway, to take note, in the above, in the red, are various formulas that can help you calculate your current percent of ownership, okay, and also your final percent of ownership, which is really based on your future value, which is based on the investment and the terminal value of the company. And ultimately what we're hoping that's going to occur is that with each series investment, what is happening is the company is hitting certain milestones. And as a result of hitting those milestones, what happens is that the company is able to increase its value. And ultimately as they move into, remember that A, B, and C, which is sort of that growth phase, that all of a sudden there is that point of where the revenue forecast really takes off. And this is the point where the value jumps significantly. And what everybody is looking for ideally would be is that going to the IPO level in terms of public markets, so that you see the returns for Series A hit 15 to 20 times, and for those in B and C, you're seeing 2 to 3 times in terms of the returns. So how do we calculate these values? Okay, and how do we calculate these values are going to be based on time value of money. So we have on the left-hand side what we call a 5-year pro forma with an NP, or net present value analysis. But to display it in terms of a more visual display, think about that present value equation, which is future value times a discounting factor, which is 1 divided by 1 plus the interest rate raised to the n, which is the number of years. So what you're doing is you can see the value that is there. The total value is discounted, and that discount is reflected by what is ultimately in the blue bar. Now the I, or the interest rate or discount rate, will vary, and that will vary with risk. Usually it is the weighted cost of capital, and when calculated, is generally about 12 to 15% with many different companies. But if you are in a more high risk situation, such as in a startup, this may be risk adjusted, and therefore your interest rates may be much higher. In some cases, it may vary anywhere from 30 to 85%. So there are different methods for valuing. Okay, there's the fundamental, which is basically straight time value money. There's the VC method, which is really the terminal values based on the price to earnings. So they're looking at pro forma statements, and they're looking at the price to equity of comparable firms that are out there. So it's sort of like real estate market. You're trying to value out in terms of how other firms have that are similar to your company in terms of the PE. And the PE times net income will give you terminal value, and the present value is then discounted from the terminal value, and with an R of anywhere from 35 to 80%, as I talked previously. The Chicago method uses a lower discount rate, but applies to expected cash flow. And then the discounted cash flow will involve 3 different periods, especially when we have companies with long-term growth prospects, and that they are going to look at a growth range, and then a range when you have revenue, and then a range where you have a consistent dividend. And as you can see, there are a number of different financial parameters in terms of sales growth rates, free cash flow to sales, and then even your net fixed assets to operating working capital over sales that are there in terms of calculating discounted cash flow. The bottom line is just to be aware that there are different methods for valuing, and that you should find out when you are dealing with the investor in terms of what method that they are using. So here's a case example of valuation. Okay, and it deals with investment into a pharmaceutical product. And you can see the assumptions on the right-hand side. The company would be sold for $250 million after 5 years. Initial investment of $1 million. A second investment would go in, so the round 2 would be phase 2, and then that buys 50% of the company. So a VC may be targeting a 25x return if everything goes right, and if things don't go right, it may be more closer to 10x. And that really gets into what we call the impact of up rounds or down rounds. So up rounds are driven by company hitting, exceeding milestones, positive results, and the economic environment. So that initial investment that we see of $1, and it would be 20% of the post money that's there, when they came into the phase 2 data and the valuation of the company pre-money, now at this point, because they hit their phase 1 milestone, is $20, and they're in a positive economic environment. The additional $20 million that come in now gives you a post-money value of $40 million. So in essence is that 20% gets diluted to 10% because of the second investment that's there. So net is that out of the $40 million, the value investment is actually $4 million. But ultimately you own 10% of the company. If there's no additional investment and you go to that 5-year mark in the sale of $250 million, 10% of that 20 of that figure would be $25 million, which would net out to be 25x. In the down round, which is where a company's missing milestones or clinical trial results didn't turn out, got to run another study, or in negative economic environments, such as in the recession, what the big difference is that the pre-money valuation on the second round is lower. And as a result of that pre-money valuation, what happens is that when you're bringing in the second round of investment, the dilution is much, much greater because the pre-money is so much less at $2 million versus the $20 million in the up round. As a result, your percent owned drops from 20 to 1.8%, and ultimately when you do sell that company, provided your phase 2 is successful, what happens is that you end up with 4.5 million or 4.5x return. So that is the key thing to keep in mind relative to investment and the timing of the investment and the influence of second and third rounds, which will do that your investment. So a good deal embodies several key characteristics, and this is new information that we didn't cover in the lecture. I think these are very common sense. They should be simple, robust, and organic. Okay, they should be generated from the partners. It should be based on trust, not legalese, and it considers the interests and the needs of both parties. A good deal should allow for good flow of communication and interpretation of responses. Again, it gets back to that trust and transparency. And it allows for revealing information about each party. And this is very important because diligence will require that, especially for the investor looking at the startup. It does not preserve discontinuities. It does not make it difficult to raise additional capital, and it allows for new information before financing to come in. And it recognizes that it takes time to raise money, as Charles has mentioned in a previous finance lecture, that sometimes you could be 6 months to be able to get that money. I have a client who is taking about 12 months to get additional rounds of money. But the net is it improves the chance of success. So these are the elements of a good deal that you should keep into consideration and look for. So it's just not about the money. It's about creating win-win with your investors. And going beyond the money is you got to think about the number, type, and mix of stocks, the features affecting rate of return, takedowns and conversions, the interest rate in debt or preferred shares, and particularly if you have convertible debt, which we'll talk about later on, board of director seats, composition, representation, as well as the management team, and registration rights for investor stocks, future private stock or IPO rights, vesting schedules, which usually are over several years to keep folks adhered to the company. Generally, you see vestings of 4 to 5 years, and payments of fees that are associated with the deal, such as the company that involved with drawing up the deal, the accounting firms, the lawyers that are there. All these players do have associated deals, and so therefore the deal has to spell out who is going to be paying. Okay? And we need to also keep in mind that the investor, okay, especially VC, let's go beyond the money. What a good investor brings, are a number of things. And I think this is very key, is that 70% of venture capitalists' time is functioning on that company's board and monitoring, giving guidance, acting as consultants. Recruiting management, many times bringing in a seasoned CEO who's been in that space, and then assisting in outside relationships. I think Charles gave an example of one VC who had connections in the entertainment industry to be able to help with either bringing in new investors or maybe potential customers. And then to close out, I think that it's always important to keep in consideration some of the burdensome issues that exist for the entrepreneur, such as co-sale, provisions in terms of with one party being able to sell, can the other parties be able to sell their ownership? Ratcheted anti-dilution protection, which is very, very important, especially with early rounds of investors. Washout financing, forced buyout, where you see with partners in terms of buyout provisions, demand registration rights, and piggyback registration rights that are there. So one is more immediate, where one is a tack on, and then last but not least is key person insurance, where you have insurance, say, on your CEO or other members of the management team. Anyway, this is the piece on the equity side. I certainly hope it gives you a good review. And if you have questions, feel free to give me an email or ask me in class. Thanks and have a great weekend.